This panel is Opportunities in China. It is headed up by Anton Shen, RMB specialist for Standard Chartered Bank. And Anton, I'm going to let you introduce your panelists and take it away from here. Thank you.
Hello. Hello. Can you hear me? Thank you very much. In this panel, we are bringing China to you. We have several experts from China. We have William Ma, CIO of Noah Holdings from Hong Kong. We have John Tang, Regional Head Financial Market East from Standard Chartered Bank, based in Hong Kong. We also have Eva Shen, Head of WFOE from Guotai Junan, based in Shanghai. That is why I said that we have the China coming to you. To start with, I would like to ask to the topic of the panel, what opportunities do you see in China? Could I start with you, Eva?
Of course, yeah. So China is a faster growing and attractive market. China's vast size and growing wealth and economic transformation will all create the opportunities for global investors. China's futures market is among the most liquid market in the world. And also it has the great intention in China and a greater potential in China. And China's equity market is worth to be part of the global assets allocation after China Asia, including MSCI index. But most important right now, the open up of the China's financial market is accelerating. Chinese government has launching many positive regulations such as the removal of QFII and RQFII quota and the lift restriction on market exercises to provide a better investing environment and encourage global asset management to enter into China, facilitate their activities in China. On July 20, the regulator authorities announced a set of 11 measures aimed at continue to trade of accelerating the opening up China's financial market for foreign investment and participation. It included the promotion of foreign financial institutions to establish or invest in pension management company. The lift restriction of the foreign ownership limited in security company and futures company, more convenient access invested in interbank bond market. As a futures broker in China, we have seen more and more new contracts and their options listed on the exchange. By the end of October this year, there have been 70 contracts are traded in the market. Also, there are more futures contracts open to the foreign investors. The foreign institutional investors established their onshore entities named WFOE, which named Wholly Foreign Owned Enterprises. And in July 2016, the WFOE can apply for PFM work qualification with China's security regulators. So that's all the opportunities I have seen in China.
Thank you, Eva.
Yeah.
What about you, John? What do you think about, in your area, opportunities in China?
Yeah, from my angle is the access to the China onshore capital markets, which is now the second biggest in the whole world. And it's not about the size, just about the size. It's also about the local relation with the other markets that make it an ideal sort of like an instrument to hedge or to diversify. Look at the size right now, right? The China bond market right now is 13 trillion US dollar, and it's still growing. And if we look into the percentage holding right now by foreigners, it's only 2.3%. If you look at the US market, which is the #1 in the world, 40% of the US bonds are held by non-American. If you look at bonds, 60% of bonds are held by non-German. If you look at the third biggest market, which is Japan, 13%, 1/3, is held by people outside of Japan. So China right now is only 2.3%. So I think it's very likely that in the next 5 years, let's call it the next 5 years, it will double. And let's say if we could reach somewhere like close to 10%, could it be achieved in 10 years' time? Might be. If we reach 10%, we are talking about additional $1 trillion going to go into this market, assuming there's no growth at all in this market. So even if this market just stays stagnant, it will be $1 trillion going into this market. So I think this will be a very big opportunity for many, many people, investors.
Thank you, John. We cover about futures, we cover about bond. William, what about you? What do you think about China?
Hi, everyone. Anton asked us to start the panel with some, funny story or make it, interactive.
Did I?
So I start by telling a story. I think in terms of investment opportunity, there is a company called NOAH, N-O-A-H. We were founded in 2003, and in 2005, Sequoia Capital became our angel investor, and we were listed in New York Stock Exchange in 2010. Going forward, there will be more, story like this, trying to capture or partnering the growth story of the whole China market. I think, that is the story that I come up with. Now, in terms of the investment opportunity, on the public space, I would say there are two different things. One is the equity side. We are seeing a lot of active investment return opportunities. Globally, we are talking about active versus passive. Passive guys, they are cheaper, they are capturing a lot of beta and market upside. But in China, we are actually seeing a good territory for the active manager to outperform the market for the following reasons. Reason number one is the market in many industries is very fragmented. And the example I would like to quote is, again, trying to be funny, is a soy sauce manufacturer in China. Soy sauce manufacturer in China, guess how many people per year, I mean, how many kilograms of soy sauce they consume per year? It's about 1 kilogram on average for the Chinese people. But 6 kilograms of soy sauce consumption in Japan. It's not that because they are eating more sushi, if you like. It's when the economy gets richer, people consume more sodium. So back to the soy sauce story, back to the soy sauce story is actually the company own about 12% of all soy sauce market share in China. But Kinkoman, the largest soy sauce manufacturer in Japan, own about 30%. So actually there is a trend for industry consolidation. This is one of the examples. And I start mentioning about this stock in China about 5 years ago. And the stock went up 10x. You can check the share price. So point number one is there is a lot of industry. They are not consolidated. Going forward, it will be consolidated. So active manager have a better chance to outperform the passive. The second is actually there are dispersion of return. For example, year to date, the best performing sector and worst performing sector in China is about 50%, 50. So being an active stock picker, actually you can add a lot of alpha. That is for the discretionary manager. And then the second point on public market is we are seeing more and more new strategy coming up. Statistical arbitrage, StatUp. I've been a global fund of fund manager for more than 15 years. StatUp is an old story globally. And then the alpha, if you like, has been compressed. But in China, StatUp is a new strategy. Year to date, the StatUp manager in China can generate 20% year to date return because of the volume has increased. And later, we are seeing the emergence of volatility arbitrage. So those are opportunities that in the public market, we are seeing that is actually alpha, for a lot of global investors.
Thank you very much, William. You can see in the panel we have equity, we have bond, we have future, we have different asset class bringing you from China.
And you should be the commodity guy.
Oh, thank you. And we also want to know from the audience, how many are you currently actually investing in China equity? How many of you investing in China bonds, fixed income markets? How many of you investing currently have doing onshore China futures?
Wow, thank you.
We know where the market growth will be.
Yeah.
Given what has been happening, I cannot get out of the panel without asking you guys, due to the bumpy road of the trade negotiation between US and China, does that affect the opportunity we just discussed? And any thoughts, comments on that?
Maybe I'll start because they are looking at me. So I think on the public market space, it actually speed up a lot of market opening and industry consolidation, like the supply chain. Now the key theme for a lot of private equity and some public market hedge fund, they're looking for the high-end manufacturing sectors because made in China become a more and more popular trend, if you like, and getting more important. So the benefit, if you like, for the potential trade war is it speeds up industry consolidation, and secondly, the market opening up, like the financial market. This year, as you mentioned, there will be fully owned kind of Chinese asset management by global firm, fully owned Chinese banks and brokerage by global firm. I think those will improve the industry dynamic and generate opportunities because of the trade conflict and trade war.
Yeah, I think on the trade war, right, in the next 6 to 12 months, both sides have a lot of incentive to reach some deal. But I think we are entering into a new normal. The two superpower is going to have a lot of up and down conflicts down the road, and it will just continue in the next, 5, 10 years or even longer. However, I think that also makes China firm up the mind that, number one, they want to internationalize RMB. They want to make sure that RMB becomes a tradable international currency. And number two, they want to open up the local domestic market even faster in order to attract more inflow into China. And so I think it actually helped to speed up a lot of the opening. And just William mentioned, right, they already announced that next year, there will be no more limit on foreign ownership, on securities company, on asset management company. Right now, if you want to get into those markets, you need to form a JV. But next year, you don't have to. You could just go in and build your own company.
Yeah. China has always been determined to open up the financial market. This remains unchanged no matter how the negotiator goes. From the perspective, this marketing has been taking steady steps. As I mentioned in the last questions, the launch of new regulations promotes and encourage new investors to participate in this market. On our side, we hope to attract more and more foreign institutions to invest in China's market, to inject more liquidity in this market. On the other hand, it could introduce more trading experience to our local players to make the domestic market more effective and stable. That's also part of the reason why the investor structure of the domestic market has been improved. Institutional investor has been an important component of the market. The domestic derivatives market started to gain significance, offering more investment choice and the choice of the risk management.
Yeah, we have been talking about, different opportunities. But when I'm sitting as an investor here, when I want to go into China, how should I prepare? What should I consider? What should I know about? John, we want to start?
Yeah, I think it's like the first difficulty or first challenge is that China have many different regulators. You have PBOC, you have SAFE, you have CBIRC, you have CSRC. So many different regulators. And a few years ago, China actually tried to merge it to form a super regulator. But that project failed. So I think it's no longer going to work like that. So there's different regulators. At the same time, there are also different provinces. Every province wants to be the first to test out some new ideas. Shanghai wants to have a free trade zone. Shenzhen wants to do something new. Every city, every province wants to start something. That created a problem was that China, from time to time, pop up different things, different ideas. So initially, you have the Q fee to enter China. After a while, then someone start to say, oh, let's do our Q fee. You could use RMB to go directly into China. Then someone start to say, oh, let's have a CIBM direct. Let's have people directly buying bonds through the CIBM direct. And after a while, the Hong Kong exchange start to come out and say, look, I could actually do a bond connect. You could, through Hong Kong, to buy China bond. So suddenly you have a different scheme, and all these different schemes could provide you different advantage, disadvantage. And everyone have to sign different documents, doing different things. So it's actually very complicated. And that's why I think entering into China from that perspective, you do need to have some partner that understand the market, that could give you ideas that which market is actually better or which access path is actually better for your company.
William, do you agree with that, or you see other things happening?
Yeah, I think regulations is, of course, number one, and there are also, because some of our clients are actually global institutional investor and pension funds, and they are concerned about the jurisdiction, legal structure. Previously, if they invest QFII, basically they can invest in a China stock, but nowadays, the more when the QFII is, disappear and you can go direct, actually they can invest in a Cayman fund structure with the administrator, auditor that they are familiar with. So in that part, the legal is more offshore, but the underlying asset is through Hong Kong Shanghai Connect, invest in a Chinese company. So they feel more comfortable on this part. But secondly is currency. So oftentimes, people concerned about, renminbi depreciation potentially and whether they can hedge, would the cost would be too much. I was told you are the expert. So what is the hedging? What is the hedging mechanism?
Actually, nowadays, the hedging cost is coming down quite fast in the past 5 years. If you look at the spot market, right, if doing FX hedge, right now you're talking about 5 pips to maximum 10 pips on the spot market. Let's say you need to do a forward to hedge. You do a 1-year forward. So you add the bid offer spread of the 1-year forward swap point. That's another 10 pips or 15 pips. So adding up together is only talking about 10 to 30 pips. That's maximum. So it's actually quite cheap right now to hedge. And also, you can also hedge in the onshore market as well as in the offshore market in Hong Kong. So there could be some discrepancy from time to time, but most of the time, actually, the two markets trade very closely together. But sometimes people, particularly foreigners, would prefer to use the offshore market, which, when particularly during crisis, will more reflect the true value of RMB compared to the onshore market, because our onshore market might be a little bit more controlled or manipulated. But in the normal time, the two markets actually very much synchronized.
Let me go into this point a little bit. I remember we talk about, William, you remind me, some of the investors, when they look at the equity market, what's the return they're looking at? I remember talk about GDP plus.
Yeah, because some of the investors, they're expecting high, single-digit, low-teens type of return, and the thesis is, long-term GDP growth in China could be 6%, 5%, plus, 4 to 5% equity risk premium. Then you got yourself a double-digit type of return before fee. Not mention about the alpha opportunity that I mentioned earlier. But, the currency is part of the concern.
And John, what roughly was the hedging cost per annual nowadays?
Yeah, if you use those sort of like a bid offer spread, right, you're only talking about a few basis points, right?
Yep.
2 to 5 basis point max. So it's actually quite minimal.
Comparing to the
1 to 2% that some people have in mind is a different, level.
So if you have this question regarding equity or hedging, come to talk to us afterward. We have a solution here for you.
Yeah, but of course it's like the bond market would not be able to generate the kind of return that the equity market could have, right? But it's still very attractive. Yep. Most people go into China to buy the government bond. If you look at the 5 years government bond, it's about 3%. And 10 years, 3.3%, something like this. But if you look at globally, most of the country now is close to 0 or some even negative, right? So if you could generate 3% plus in the fixed income market, is actually quite attractive. Of course, you will talk about, okay, how about the currency? Would there be currency depreciation, which you have to build into your expectation and how to hedge it? Yeah.
So we have a solution for bond investment plus hedging, and also equity plus hedging. So Eva, what about you? What do you think investors should consider when they go into the futures market? What challenges they're facing? Yep.
Because it's different for the futures trading. So currently, there are 3 ways to enter into China's market for futures trading. The first method is QFII. QFII allows the qualified foreign investors to invest in listed equity and bonds. And it's worth noting in January this year, Chinese regulator CSRC released a consultation paper to propose a QFII regulations that expands the investment scope. It included allowing QFII to invest in domestic private fund and commodity futures, options, etc. The second method is to set up a PFM WFOE until the new QFII regulations takes into effect. The strategy of global managers cannot be fully implemented in China. Therefore, to those foreign players who have long-term plan in China, they could establish a PFM WFOE in China. The PFM WFOE is treated equally as a domestic private fund, which means it can raise funds locally and can invest all instruments in China. The third method is the international futures contract. If you just want to test the water, maybe you can trade the international contract at the beginning that requires you neither a Q fee nor WFOE fee. You could direct trade as an overseas player. Currently, there are 4 futures contracts open to foreign investors. They are crude oil, iron ore, PTA, and TSR20.
Yep. I'm just thinking, like, we are talking a lot of things like quite theoretical. If I want to go into, I don't have any experience, like, although being a Chinese, investing into China market, I want to go into the equity market. What should I do the first thing?
I think because of the market opening and the Hong Kong-Shanghai Connect, actually it's very convenient and easy for you to invest in a standard Cayman fund structure, and then the fund underlying will invest in the China Asia. So it's no different for you to invest in a European fund, but a Cayman fund structure, or US fund, Cayman fund structure.
John, what about, like, I want to go into the bond markets? What should I do as the first step?
I think for a lot of asset managers, right, the easiest one is you approach a bank which could help you to open an account in Hong Kong. So that will be a Bond Connect direct. So everything will be signed with the sort of like a sort of like a Western familiar environment. And then the custodian will be actually in Hong Kong. And then through that bank, you could actually purchase bond in China. And in the future, and on the hedging, you could also do the hedging either in Hong Kong using the offshore market or using the onshore FX market.
Yep. Okay. Eva, what about, like, I'm first into the future market as a foreign investor.
Yes.
What is the first step that when I go into the market?
So choose the right way to enter into China. You have 3 ways. I said last versions: Q fee, WFOE fee, and internationalized contract. And choose the way you want to.
So choose first and then talk to you.
Yes. So choose a right partner is very important.
Okay, let us change gear a little bit. When we are in US, we also, we want to know the markets. US market is very important, but we also at the same time want to know what other peoples are doing. European investor, so Asia investors, like, it is quite different dynamics. Given you guys are sitting in Asia, what are you doing? What other investors are doing in your specific field? John, do you want to start?
I think depends on the client group, right? If you look at central banks, sovereign funds, reserve management, right now about 60 of them already invest in the China bond market. I think the Asian central banks and sovereign funds are more aggressive. So they are buying into the China market in a much bigger scale. In terms of asset managers, asset management, right now there's actually, I think altogether, more than 2,000 investors have already registered. Some of them European, some of them American. I think both are very active, and the top asset management are all in the market already. However, if you start to look into the corporate, I think European are more, sort of like they're a few steps ahead of US. So European corporate are actually using more RMB also as settlement. So they're not only buying into the bond market, they're also using RMB for settlement. However, we do not see a lot of US corporate doing that yet. Might be politically is some reason for that.
Eva, would you want to?
Okay, as China's financial market are growing rapidly, the investors from European and Asia are preparing for a better landing for their capital. China is now the second largest economy in the world with the most trading volume of base metal and agricultural product, etc. While more and more futures products are about to list in the exchange, the presence in China's market is necessary for global investors' asset allocation. Also, it's reasonable for China's financial market to open more and attract more foreign investors. European and the Asia market have the close relationship with the Chinese real industry, which is the reason why their demand for commodities hedging is growing dramatically. Therefore, most of them will choose a right partner to do the local capacity building. Yeah.
And for the Asian investor, I think given their business or their asset are Asia-based, which is technically speaking more correlated to the China asset classes. So when they invest in the domestic China market, they are more looking for the future growth opportunities, so it's from a return perspective. From my understanding, European investor, when they invest in the China or Hong Kong market, they are looking for more stable cash flow. For example, now some of the banks, Chinese banks trading at the Hong Kong Stock Exchange are yielding about 6 to 7% dividend yield, trading at 0.7 times price to book, which is kind of like attractive, stable income type of asset class for them.
Since we're in that topic, actually, we also want to know for US investors or European investors, when they access the China market, normally, how do investors do the setup? Do they, because of the time zone difference, are they, like trading out of US mostly, or do they have Singapore always? What is the best practice? Because, this is one of the key questions, the operation we have to figure out. Anyone want to go for that?
I think you could do both, right? A lot of the bigger funds, they actually have a setup already, mostly in Hong Kong or Singapore, and then during Asian time zone do the trading into the bond market. But at the same time, actually, even in New York time zone, right, they could actually also do a lot of the hedging activities.
Yep. I agree with you. Hedging, like the FX is quite liquid now. William, any thoughts?
Yeah, I think in terms of operation, because historically Japan has been a big market for a lot of global investors a long time ago. So I think people do have experience in dealing with the Asian time zone. Same as trading Hong Kong, Australia, to some extent, ASEAN. So China should not be anything big difference.
Yep. Eva, any thoughts on that? Do you see company?
I think for trading in China, it's better to do the simulation test in China to adopt the market and the regulation, because it's totally different.
Yep. So you are saying actually, I'm also seeing that actually more and more company actually set up in Shanghai as well, right? So apart from, of course, like US headquarters, like I know like some of the investors still do night trading. Also can consider Singapore, Hong Kong, or Shanghai office.
Yes.
Since we are also in that topic, I'm just curious, do you expect the liquidity in China, no matter equity market, bond market, FX market, we know that CNH is like now in US hours quite liquid, is okay. What about bond market? What about futures market, equity market? Would there be a chance that, for example, Asia, Asia can trade US stock through ADR? Whether US can trade Chinese equity, Chinese bond over here?
I think right now, right, if you look at the Chinese bond market, majority of the purchase from foreigners are still the China government bond and also the policy bank bond. There's very little interest in corporate bond. I think one of the reasons was that corporate bond, do you trust the local rating agency? And there's not a lot of transparency. And of course, nowadays, Chinese regulators start to allow S&P and in the future Moody's or Fitch to come in and do their independent credit rating. I think that will help, but it will take many years. So right now it's still, if you look into like we call it CGB, the China government bond market is extremely liquid. You could get in and get out very easily. But if you are looking into the corporate bond market, it will be very difficult. And quite often, the Chinese local banks buy the corporate bond. They will buy and hold. They will not sell. So that's not a secondary market. And the difficulty was also because the local rating agency, everyone is AA. So you can't really distinguish this one is better than the others, right? And because they hold to maturity, it's really depending on the local investor, how much they know about this company. And it's very difficult for a foreign investor to go in and understand that market. So that market will take much longer time to develop.
So you are saying the opportunity nowadays are probably more in the
more liquid government
bonds market than credit. What about like the more liquid market? Do you think of the hours of trading will be extended in the future for U.S. investors to trade here in this time zone?
We have proposed sort of like lengthening the time of trading, but I think it's like it would take times because it's like right now the investor going in, as I said, is only 2.3%, right? As the China government start to see that, okay, more and more interest is coming out from different time zones, I think they will extend it. But meanwhile, I think they sort of like still want to keep it.
So probably keep it at the moment, but in the future can potentially, extend it because when we talk to clients here in this space, a lot of clients want to trade, in this time so that they don't have to stay late. William, what about you?
On the equity side, liquidity is not a big concern in the China market. For example, early on this year, when the market is really hot, the market daily volume is about 1 trillion renminbi. So it's a huge kind of liquid market. And part of it is because of the trading pattern for retail and institutional investor in China. Guess what is the annual turnover of the mutual fund manager in China? We are talking about 10 to 12 times portfolio turnover per year, which is the broker would be very happy, trading at 1 basis point. But I think it's the nature of the China-Asia market that liquidity is quite large compared to the global hedge fund. If you like, they're trading at 1 to 2 times portfolio turnover.
What about the time zone? Do you think I think there are ways for U.S. investors to trade Chinese stock here in U.S., right?
Yeah, I think time zone is one concern, but I don't think it's a huge or big hurdle if you like, because if you look at the Asian investor, when they invest in the US market, sometimes they hire a portfolio manager, they outsource, they allocate to a US manager. Maybe we can also consider do the same thing. You invest in a China manager, let them on the ground do their work, rather than building your own team, trading stocks from a different time zone.
Eva, I'm not sure that conversation came up at all regarding time zone with U.S. investors on the futures market.
Because in China's futures market, we have the daytime trading and we have the nighttime trading. So I think it's no problem for the foreign investors.
Oh, okay. William, just now you touched on the liquidity and the cost. So I just want to go in a little bit, like in terms of the public market, private market. How do you see the liquidity, the cost, etc., for investors when they go in and out?
I think public market is very cheap if you like. The average commission is 1 basis point, 2 basis point if you like. So that part is not very expensive. Private equity, if you like, as we discussed, by some of the panelists early on this morning, I think in terms of valuation, it's getting to a demanding stage, if you like. And the Chinese government is trying to solve this, the IPO pipeline, by launching of the Star Board, the new technology board, so that some of the companies, they want to get listed, at least they get more window or a market approach to get them listed. So I think liquidity will improve, and the funds can kind of like when they expire lockup, they can return capital to the investor earlier because of the IPO liberalization, if you like.
Yep. John, what about in the bond markets, the liquidity, how does it work in the bond market?
Yeah, as I mentioned earlier, right? Right now the liquidity, if you go into the government bond market, will be very, very good. Yeah. But then not so for the corporate bond.
Apart from China govies, are there any other bonds that would good liquidity?
The policy bank.
Policy bank.
The policy bank, like the construction bank.
China Development Bank.
Development bank.
Yeah, probably those are the ones that investors are choosing. Eva, what about the liquidity in the futures market? What do you?
Because in China, they have the physical market and the futures market, so the liquidity for the commodity is very well.
And I do have an extra observation on the bond market in China. Our clients, style, if you like, is more like hold to maturity. So when a bond is being issued, basically they would hold until it's being mature. And the second question for lack of liquidity in the China domestic bond market is because of the rating agency. Historically, the spread between what you call good quality company and less good quality company, the spread is quite tight, which means active credit manager do not add a lot of value because of the credit agency and lack of liquidity. But now, early on this year, S&P is being allowed in China to start doing, credit rating. I think those would enhance the liquidity of the public bond market, and that would also increase the liquidity down the road.
Yeah. Let's go into a little bit because like China rating landscape has always been there, have their own landscape, right?
Yeah.
So what do you think, like in the future, how with the Moody's, S&P, Fish, when they go in, they would adapt to the market, or they would bring international standard to China? How do you think that would play out?
I hope so. I hope that they will bring international practice, right? But we also hear that there could be some twisting to adapt to the local environment. Yeah. And I think this whole process will take long time because a lot of the corporate, when they issue bond, they know that they have enough domestic investor to buy it. So why bother? Why bother to go to a foreign rating agency, right? Unless there's a big incentive. Might be the government say that, oh, you being such a big company, if you issue a bond, at least you should target to have a certain percentage to be held by foreigners, foreign investors. Then they will be pushed to go to S&P or Moody's in the futures to do some rating.
This is an interesting point because it's not just about foreign investor going into China, also about how the Chinese local investors are responding. How several. Oh, I have a lot of questions. Sorry. What are Chinese local players nowadays doing, and how are they responding to foreign investors coming into China?
I think because of the fact that China is lacking of investment instrument, right? You don't have a lot of choice. The Asia market is not that big. Then you have to buy bonds. Other than that, then you buy properties, and that's why there's this bubble in the property market. There's not a lot of investment, and now even the sports shoes, right? Everyone is taking a bet and then doing that. So I think it's like local investors. They're looking for yield, so they will. Many of those corporate bonds, when they come out, is very easily sort of like bought up by the domestic investors.
Okay. Eva, what about the local, like there was a very big local participant in the futures market. And what are they doing right now? What are they responding when, foreign investors coming in?
So we'll wait and see, actually.
So they don't think foreign investors will come in that quickly? I mean, we have the capital power.
Of course they will. So because they think they are the technology and the trading system is maybe better than the domestic market. So just choose the wait and see the attitude.
Probably nothing better to do.
And on the regulation side, actually we are on the Asian Committee of the Hedge Fund Standard Board, SBAI Standard Board of Alternative Investment, together with some of the pension funds in the region like GIC, CPPIB, and Hong Kong MA. And we talk to the Chinese regulator on a regular basis, AMEC. Actually, the direction and approach is to open up or to upgrade the domestic hedge fund standard, and they're adopting a lot of those policy and rules and regulations. I think those would help domestic fund manager and global manager when they come in to compete or to understand in a common ground, if you like. And secondly, your question regarding what is the appetite for QFII or global investor in the China market. The good thing is you can look it from the QFII data. They publicize what companies the QFII is buying. Now the most popular kind of companies or sector, if you like, is consumption, Maotai, and also some of the banks in China. So I think consumption is a big theme that for global investors participating in the China market. While, as I mentioned earlier, the domestic fund manager, of course, they like healthcare and consumption. But at the same time, there are some unique theme, maybe some mid-sized company that unless you're on the ground, do the research, otherwise it's hard for them to discover.
Yeah. So William, do you see foreign investors also partner with local investors, do some kind of research to invest in those companies, or?
Yes, if you look at the trend, some of the global investors, one, they are either building their own in-house direct team, based in Hong Kong, and then hiring local team to invest in the China-Asia market, or actually they are big allocator to some of the fund houses, in China, so that they use the on-the-ground knowledge to access the China market.
And local investors in China, they are receptive to collaborate with foreign investor.
Yep.
Are they feeling their market is being like there are more people getting into the market?
I think it's a good thing. If you look at the market dynamic in China, 80% of the market volume is retail investor, which makes the market
Yep.
very volatile,
Yep.
which is, provide, of course, good opportunity for active manager, but at the same time, it's bad for the common investor because, if the volatility is high, chances are you are buying high and selling low, if you like. So if there are more institutional global investor to take counter side of the trade, the volatility in the China market could be more dampened. I think that would be benefit for the overall, market, if you like.
Yep. So just now we talk about like the equity and the bond market. Another important topic for this one is actually index inclusion. We are seeing for equities coming, for bond coming. I'm thinking about for futures, like what can be leveraged on that. What's your thoughts on the index inclusion and how it change the dynamic of the markets?
In the bond market, definitely is a very, very big sort of like a factor affecting the inflows into China, right? Our estimation was that if all the three major index start to include China bond market into their index, we think that there will be passive investment will be over 280 billion will go into China just because of the passive requirement to follow the bond.
Yeah, same situation for the equity market. For example, year to date, the Q3 flow is about $20 billion already compared to 52 billion last year, but this year is a little bit bumpy compared last year. So I think the MSCI index inclusion on the equity market definitely provide extra interest from global investor to look at the Chinese market growth, if you like.
So we talk about passive and also potentially we can bring in more active investor coming in as well. Eva, any thoughts on that, on the index inclusion? Or
I think it injected the liquidity into the market and raised the confidence for the investors for the market.
Yep.
Yeah.
So I also heard you guys just mention about the regulator, like which is very important part when investing into China. We want to know, like just basic, like what are the relaxation lately? Probably you guys touched on a little bit, early on, or what you expect for the future relaxation in your respective area. Eva, John?
Yeah. It appears that the opening up of the China's financial market continue to make the steady progress, and the Chinese government has been promoting a gradual opening up, encourage global asset managers to enter into China's market and facilitate their activities in China. It is likely that the regulators will continue to provide market access for highly quality institutions, just like the top-notch hedge fund and the asset management, but they will also maintain their cautious approach on issues such as cross-border capital flow to avoid the possible risks.
I think it's very likely that they will allow foreign investors to access the CGB bond futures market in China. So they could hedge in the bond futures market. And I think the next relaxation probably will be on repo, allowing foreign investors to do repo on their bonds.
So that would be allowed for both Bond Connect and CIBM Direct.
Yeah. But I think the futures, assessing the futures market will come first.
Will come first. So that would be the, for the investor as well as for the banks as well.
Yeah.
On the equity side, because, Q3 is no longer needed and Hong Kong Shanghai Connect is actually in good progress. I think the direction is go two ways. If you recall earlier on, we've got a China-London Connect as well. So I think the traffic is going to be both directions in terms of opening, letting domestic investors participate more to the global market as well. And the longer term opening and go, if you like, I think has to be higher level, like renminbi internationalization and interest rate liberalization. So these two are the 10 years goal of the Chinese government, and that point I think is in good progress.
How does the renminbi internationalization come into the picture with the equity?
I think in the equity world, it's all about asset allocation and diversification. I think for the domestic Chinese investor, as John mentioned, there are limited asset classes they can invest, property, fixed income, less extent, and then equity market. So if renminbi internationalization can go bigger, actually the Chinese asset can invest in more diversified asset in their portfolio. It's now being estimated among the high net worth in China is 5% of their asset is global investment. And for US, investors, it's about 15, and in Europe, it's about 40% of their portfolio is global investment. So I think renminbi internationalization definitely help the domestic Chinese investor to diversify their portfolio.
What do you guys think about renminbi internationalization? How does that interact with your area?
I think it's like definitely that is something that the government is pushing very hard, but it's not easy, right? I think the setback in 2015 when they depreciate the currency, making a lot of people worry about capital control, policy changes. So even now that is included in the job, I think a lot of people still have reservations, so it will take time. But definitely that will be the direction, particularly under the trade war. China government is getting more and more worried that in the future, if they have to do everything in US dollar, that would be a major,
So is good and bad. There are, opportunity. At the same time, there are a lot of challenges. Like, the government have to do the investor when we go in. We have to face. This is not a straight way path. So I know we are running out of time. I want to, end our session with just asking each of you to give, just one sentence, what should investor do to capture the opportunities you just mentioned? Just one sentence.
Okay, I'll start first. In your next summer, maybe spend your summer holiday with your kids in the second and third tier city in China to observe the growth.
So second and third tier city, that is the key. I get that.
Yeah, I would say it's just the beginning. So the market is just start to grow. So
Just
a
start.
lot of opportunity.
So still a lot of opportunity waiting for you to capture.
I think 3 steps. The first is know about the market, and the second is learn about the regulations. Last but not the least is find the right and the local partner, maybe the right broker in China can solve the problems locally. Yeah.
Right partners like our panelists today.
Yeah.
Thank you very much. Again, Eva, John, William.
Thank you.
The 2019 Greenwich Economic Forum is brought to you by Bridgewater Associates. Meaningful work, meaningful relationships. Churchill Asset Management, Nuveen, a leading provider of senior and unitranche debt to middle market companies. Ropes & Gray, bright past, brilliant future. Aurora Capital, inspiring partnerships. And Gramercy Funds Management, we are emerging markets. Special considerations to Bank of America, life's better when we're connected. Noah Private Wealth Management, a leading wealth and asset management service provider in China. Guotai Junan Futures, a leading brokerage firm for commodity futures and financial futures in China. China Industrial Securities, a comprehensive financial group providing full spectrum financial services in Hong Kong. And Titan Advisors, built like a hedge fund. Special thanks to the Financial Times and Greenwich Business Institute for hosting us. And thank you to all the sponsors who helped make this event possible. We'll be right back after these messages. Don't go away.